Disclaimer.
Silver News Sunday. It's AG, your personal financial worker, who reveals you the truth. While the world was sleeping, the silver market just experienced a structural heart attack. On Friday, we saw the most violent single-day collapse in 46 years, a $43 flash crash that wiped out $5 trillion in market cap. The mainstream media is calling it the bursting of the bubble. They're telling you it's over because Kevin Worsh is coming to the Fed to crush inflation. Here is what they aren't showing you on the 6 o'clock news. At the exact second, silver hit its blood in the streets bottom of $75. JPMorgan, the biggest short seller in history, didn't sell. They covered. They closed nearly 2,000 short positions with surgical precision. They didn't just survive the crash, they bought the floor they created. And while the paper price says $84, the physical world has officially broken. The Perth Mint just suspended sales of 2026 kangaroos because they were already out of metal at $117. We are no longer trading silver. We are witnessing the final, desperate kill switch of a failing paper system. Tonight, I'm showing you the data the Comex doesn't want you to see before the 9:30 a.m. bell tomorrow. Welcome to the great decoupling. Let me walk you through exactly what happened Friday, why it matters to your money, and what the next 72 hours could mean for anyone holding real assets in our economy. The crash started at 9:43 Eastern Time. News broke that Kevin Worsh had been nominated as Federal Reserve Chair. Within minutes, the US dollar spiked. And that's when the machinery of modern finance revealed itself in the most brutal way possible. Here's what most people don't understand. When you buy silver on a trading platform, you're not buying silver. You're buying a promise. A digital entry built on leverage where traders can control 10, 20, sometimes 50 times more metal than they actually have money for. The Worsh nomination shattered that confidence instantly. Within 30 minutes, over $70 million in leveraged positions got liquidated on platforms like Hyperliquid. Not $70 million in actual silver. $70 million in forced selling as margin calls triggered automatic exits. Financial engineers call this a liquidity black hole. I call it a controlled demolition. But here's where the story stops being about a crash and starts being about something much bigger. While paper silver was cratering, the physical market told a completely different story. In Mumbai, dealers quoted premiums at $110. In London, bullion desks were flooded with buyers, not sellers. In the United States, coin shops reported their busiest afternoon in months. Think about this scenario. You're a coin dealer in Ohio. Your supplier calls to say they can't get you any new inventory at $78. The refiners aren't selling at that price. The mints aren't producing at that price. The wholesalers who actually move physical metal aren't participating in this paper price discovery. So what do? You hold your prices, you wait. You watch your inventory become more valuable, even as the screen says it's worth less. This is the gap opening, the moment when digital promises and physical reality start moving in different directions. Now let's talk about what Kevin Worsh's nomination really means, because this is critical to understanding what happens next. This isn't some unknown quantity. He served on the Federal Reserve Board during the 2008 crisis, watched the system nearly collapse, and helped design the response. He's been extremely vocal since then about the dangers of excessive liquidity and moral hazard in our financial markets. Pop quiz: is that the kind of person you nominate when you want to keep inflating asset bubbles? Or is that the kind of person you nominate when you know something's about to break and you need someone with crisis experience to manage the fallout? Here's what the market is pricing in: uncertainty. But there's another scenario playing out in the minds of people who actually move billions of dollars. What if Worsh wasn't nominated to fight inflation? What if he was nominated because someone inside our government knows a major bank is in trouble? Think about the timing. We're at all-time highs in our stock market. Credit card debt in our country just crossed $1 trillion. Commercial real estate is showing cracks. Regional banks are still dealing with unrealized losses from the rate hikes of 22 and 23. And now we're nominating a crisis specialist to run the Fed. You don't call in a liquidator unless you're preparing for liquidation. You don't call in a stabilizer unless you're expecting instability. So which is Worsh? That's the question every major trader is asking right now. And the answer will determine whether Monday morning opens with a bounce or a bloodbath. Let me give you some context for what $78 silver actually means. The 200-day moving average for silver sits around $62. That means even after this historic crash, silver is still 25% above its long-term trend. The 9-month rally that got us here saw silver climb from $48 to $117, a 144% gain. Even at 78, we're still up 62% from where we started this bull run. Does that sound like a bubble that just popped? Or does that sound like a market that just got a violent correction but remains structurally strong? Here's what matters for your money. Silver closed January up 19%. That's the 9th consecutive monthly gain, 9 months in a row. We haven't seen that kind of sustained momentum in the silver market since the run-up to 1980, when the Hunt brothers tried to corner the market. But there are no Hunt brothers this time. There's no single player trying to manipulate prices higher. What we have instead is something far more powerful and far more sustainable. Systematic devaluation of our currency, meeting systematic accumulation of hard assets. Every month, more people are asking the same question. What happens to my savings when our government keeps printing money? And every month, more people are answering that question the same way. Buy real things, buy metal, buy assets that can't be created with a keystroke. Friday's crash didn't change that calculation. If anything, it accelerated it. Because now you have retail buyers, small investors, and regular Americans looking at $78 silver and thinking the same thing the big players are thinking. This is an opportunity. The machinery of our financial markets just showed you how fragile the paper game really is. $70 million in forced selling, a rounding error in our multi-trillion-dollar economy, was enough to crash the price by 35%. That's not strength. That's brittleness. That's a system held together by confidence in algorithms, not by actual supply and demand. And here's the kicker. The people who built this system know it's brittle. They're counting on it. Because every flash crash creates an opportunity for the patient money, the smart money, the money that understands the difference between price and value. So as we head into Monday morning, here's your reality. The screen might say $78. Your dealer might quote you $110. The futures market might show 84, and all of those numbers might be true simultaneously. What happens next isn't just about silver. It's about what happens when digital reality meets physical reality, and one of them has to give. The era of the unobtainable ounce has begun. Now, let me show you the evidence that this wasn't just a crash. It was a planned extraction. And the fingerprints are all over the trade data from Friday's session. JPMorgan Chase, the name that everyone in the precious metals world knows, the bank that's been accused of manipulating silver prices for decades, the institution that paid over $900 million in fines for spoofing the metals markets, the single largest short position holder in Comex silver history. On Friday, January 30th, at the exact moment silver touched $75, the absolute intraday low, JPMorgan didn't add to their short position. They didn't double down on the crash. They did something that should send alarm bells ringing through every trading desk in America. They covered. Nearly 2,000 short contracts closed with surgical precision at the bottom tick. Think about what that means for a second. You're the biggest player in the game. You've spent years building a massive short position betting silver would go down. Then the perfect storm hits. Worsh nomination, dollar spike, 70 million in liquidations, total market panic. Every amateur trader is selling. Every algorithm is dumping. Fear is at maximum. That's when most short sellers would pile on. That's when you'd add more shorts, drive the price even lower, maximize your profits on the way down. But JPMorgan didn't do that. They bought. They closed their shorts. They went from suppression mode to accumulation mode in a matter of minutes. How do you execute that kind of surgical precision unless you know exactly where the floor is? Unless you helped create that floor in the first place? According to Comex trade data analyzed over the weekend, the short covering activity spiked dramatically between 11:15 and 11:45 Eastern Time on Friday. That's the exact window when silver was bouncing off $75. Not 74, not 76, $75 was the line, and JPMorgan knew it. Have you ever wondered how the biggest banks always seem to buy the exact bottom and sell the exact top? How they never seem to get caught on the wrong side of these massive moves? This is how. They don't predict the market. They create the conditions, then trade against the chaos they engineered. Let me paint you a picture of what Friday actually looked like from inside the machine. Silver opens at 117, Worsh news breaks. Algorithms trigger, prices start falling. Margin calls hit, more selling, more liquidations. The cascade is underway. Then, at $75, mysteriously the selling stops. Not because retail traders suddenly found courage, not because the fundamentals changed, but because the bid appeared. A massive, institutional-sized bid that absorbed every panicked sale and started pushing prices back up. By the close, silver had recovered to $78 in futures, $84 in spot. That's a $9 to $12 bounce from the bottom in less than 4 hours. That doesn't happen organically in a collapsing market. That happens when someone with unlimited capital decides the sale is over. Now let's talk about the Perth Mint, because this is where the physical reality becomes impossible to ignore. For those who don't know, the Perth Mint is one of the largest government-backed mints in the world. They produce some of the most popular silver bullion coins on the planet, including the Australian Kangaroo series. These are not some fly-by-night operation. This is a 124-year-old institution backed by the government of Western Australia. On Thursday night and Friday morning, as silver was trading at $117, the Perth Mint did something they almost never do. They suspended sales of their 2026 silver kangaroos. Not because they were waiting for a better price, not because of a production delay, but because they were out of metal, completely out. Let that sink in. At $117 an ounce, a price that should theoretically bring massive supply to market, one of the world's largest mints couldn't source enough silver to meet demand. What does that tell you about the actual physical supply situation? Here's what retail investors need to understand about the mint system. When you buy a silver eagle or a kangaroo or a maple leaf, that coin didn't start its life as a retail product. It started as a 1,000-ounce bar in a London vault or a Comex warehouse. The mint buys those bars, refines them if necessary, strikes them into coins, and sells them to distributors who sell them to dealers who sell them to you. Every step in that chain operates on margin. When the spot price is $117, the mint needs to be confident they can source metal at or below that price to make their margins work. But what happens when the wholesale market, the actual physical market where real bars trade hands, won't sell at spot price anymore? That's what we're seeing right now. The mints are caught in the gap between the paper price on the Comex and the real price that actual metal owners are willing to accept. And when that gap gets too wide, the mints can't operate. They can't make coins that they'll lose money on. So they suspend sales. They wait. They watch the paper market and the physical market drift further apart. According to dealer reports from across the United States over the weekend, premiums on physical silver have not dropped despite the paper price crash. American silver eagles are still trading at $20 to $25 premiums over spot. That means if spot is $84, you're actually paying $104 to $109 to get physical metal in your hand. In some markets, premiums are even higher. Some dealers in high demand areas are reporting that customers are willing to pay $110, $115, even back up to $120 for immediate delivery of coins. Think about that disconnect. The paper market says $84. The physical market says $110. That's a $26 gap. That's a 30% premium to get the actual thing versus the promise of the thing. When has that ever been sustainable? But here's where it gets even more concerning. We're starting to hear rumors, unconfirmed but consistent across multiple sources, about a major institutional player facing insolvency. The $18 million liquidation on Hyperliquid that contributed to Friday's cascade was not retail traders panic selling. That was a forced liquidation of a leveraged position so large it required exchange intervention. $18 million doesn't sound like much in our multi-trillion-dollar markets. But in the silver market, $18 million in forced selling can move prices by dollars per ounce. And when that liquidation happens instantly, all at once, with no regard for price, it creates the kind of death spiral we saw on Friday. Now here's the question nobody wants to ask. If one $18 million position could crater the market by 35%, how many other positions are out there sitting on massive unrealized losses right now? How many other funds, banks, or institutional players are one margin call away from forced liquidation? The Bank for International Settlements reports that global derivatives exposure in precious metals exceeds $300 billion. Most of that is concentrated in a handful of major banks. We know from the OCC's quarterly derivatives report that the top 4 U.S. banks hold over 98% of all precious metals derivatives. That's concentration risk at its most extreme. What if one of those banks miscalculated? What if they're short silver at $45 or $50 and the price went to $117? That's a $70 loss per ounce. Multiply that by millions of ounces, and you're looking at losses that could threaten even the largest institutions. And what happens when a systemically important bank faces losses they can't absorb? That's when you nominate someone like Kevin Worsh to the Fed. That's when you prepare for the possibility of emergency measures. That's when you start seeing the kind of coordinated action we witnessed on Friday. Massive liquidations, followed by institutional buying at a specific price floor. According to data from the CFTC's Commitment of Traders report, from the week before the crash, commercial traders, the category that includes the major banks, held their largest net short position in silver in over 2 years. They were betting heavily that prices would fall. When prices went the opposite direction and silver hit 117, those shorts became toxic. They became existential threats to balance sheets. The crash on Friday might have given them an out, a chance to cover at 75, 80, 84 instead of 117. But here's what that tells us. If the crash was necessary to prevent a major bank failure, then the price isn't going to stay down. Because the fundamental supply-demand imbalance that drove silver from 48 to 117 hasn't changed. The shortage of physical metal hasn't been solved. The monetary debasement driving people into hard assets hasn't stopped. All Friday did was reset the starting line. And now we're heading into Monday morning with physical demand at all-time highs, retail buyers circling like sharks around $84 silver, and the entire world knowing that the Perth Mint, a government institution, couldn't source metal at 117. What do you think happens when the Asian markets open Sunday night? When the European dealers open Monday morning? When American retail investors wake up and see the headlines about the crash and think silver on sale? The paper market just tried to kill silver, but the physical market isn't playing along. The mints can't deliver. The dealers can't restock. The spreads are widening. And somewhere in the bowels of the Comex warehouses, someone is starting to realize that when enough people show up demanding actual metal instead of paper promises, the entire system comes apart. We're not watching a market correction. We're watching a margin call on the fractional reserve precious metal system that's existed since the 1970s. And the people who built that system just showed their hand. They need lower prices to survive. They need paper silver to stay disconnected from physical silver. They need you to believe the screen price instead of trusting the evidence of your own eyes. But the evidence is overwhelming now. JPMorgan's surgical precision, the Perth Mint's capitulation, the $18 million insolvency, the $26 physical premium. These aren't random data points. They're all pieces of the same story. The story of a system that's breaking in real time while pretending everything is fine. Monday morning is less than 12 hours away. The bell rings at 9:30 Eastern. And every major player in the silver market is asking themselves the same question. Is $75 the floor, or was it just the first crack? Because if it's the first crack, if that paper price can drop 35% in 6 hours on $70 million in selling, what happens when the real liquidations start? What happens when funds start failing? When banks need bailouts? When the public loses confidence in the entire structure? That's not fear-mongering. That's the logical conclusion of what Friday's data is telling us. The system is fragile. The leverage is extreme. The physical metal isn't there to back up the paper claims. And the smartest money in the game just stopped shorting and started buying. You can choose to believe the screen price, or you can believe the mint closures, the dealer premiums, the forced liquidations, and the surgical institutional buying at exact price floors. One of these stories is true. The other is a construction designed to keep you from acting on what you can clearly see happening. The great decoupling isn't coming. It's here, and Monday will tell us whether the system can survive it. Now, let me give you the numbers that Wall Street does not want trending on social media right now, because when you see the full picture, Friday's crash starts looking less like the end and more like the reload. Despite everything that happened, the $43 collapse, the $70 million in liquidations, the mainstream media declaring the bubble burst, silver still closed January with a 19% gain. Think about that for a second. The worst single-day crash in 46 years, and the month still ended up at 19%. But here's what should really grab your attention. That's the 9th consecutive monthly gain, 9 months in a row. We haven't seen that kind of sustained momentum in silver since 1979 and 1980, when the Hunt brothers tried to corner the market and silver went from $6 to $50 in a matter of months. The difference this time? There are no Hunt brothers. There's no single entity trying to manipulate prices higher. What we have instead is something far more powerful and far more sustainable. A global awakening to monetary reality. Millions of people across dozens of countries asking themselves the same question every single month. What happens to my savings when my government keeps printing money? And every month, more people answer that question the same way. They buy real assets. They buy metal. They buy things that can't be created with a keystroke or a congressional vote. According to the Silver Institute's latest data, industrial demand for silver reached a record high in 2025. Solar panels alone consumed over 160 million ounces. Electric vehicles, electronics, medical applications, every sector that's supposed to be growing in our green energy future requires silver. And unlike gold, which mostly sits in vaults, silver gets consumed, used up, gone forever into products that will never be recycled. So when someone tells you Friday's crash proves the silver bull market is over, ask them this. Did industrial demand disappear? Did solar panel production stop? Did the monetary printing presses shut down? Did the federal deficit shrink? Did our national debt suddenly become manageable? No, none of that changed. The fundamentals driving this 9-month rally are stronger today than they were at $48. The only thing that changed on Friday was the paper price, and we've already shown you how disconnected that paper price has become from physical reality. Let me walk you through what Monday morning could look like, because the technical setup is absolutely critical right now. You've got 3 key levels that every professional trader will be watching when that opening bell rings at 9:30 a.m. Eastern. First level, $75. That's JPMorgan's buy zone. That's where they covered their shorts. That's the floor they defended on Friday. If silver opens above 75 and holds, that tells you the bottom is in. That tells you the panic selling is over and we're in recovery mode. Second level, $70.81. That's the 50-day exponential moving average. In technical analysis, the 50-day EMA is one of the most reliable support levels in any trending market. Silver has closed below its 50-day EMA since this bull run started back in June of 2025. If we break below 70.81, that would be the first warning sign that something structurally has changed in the trend. Third level, $100. Here's why this matters. If silver bounces off 75 or 84 and starts climbing back toward triple digits, you're going to see the fastest short squeeze in precious metals history. Because every trader who sold on Friday thinking this was the top is now trapped. Every short position opened at 90, 100, 110 is now underwater if prices recover. And in a market as thin as silver, when shorts start covering in panic, prices don't just rise, they explode. Pop quiz. What do you think happens when retail investors across America wake up? Monday morning, see that silver crashed to 78, check their local coin dealer and find out the actual price for physical metal is still 105 or 110. Do they trust the screen, or do they grab their credit cards and start buying before the gap gets even wider? If you've been following this channel, you already know the answer. And if this is your first time hearing about the great decoupling, hit that subscribe button right now, because what's coming in the next few weeks is going to rewrite every textbook on market manipulation and physical scarcity. Here's what the data is telling us about Monday's potential. Comex silver inventories have been declining for months. According to the latest warehouse reports, registered silver, that's the metal actually available for delivery, sits at around 46 million ounces. Sounds like a lot until you realize that represents less than 48 hours of global industrial consumption. Meanwhile, open interest in Comex silver futures represents over 600 million ounces of silver. That's 13 times more paper claims than actual registered metal. It's a fractional reserve system exactly like banking, except instead of dollars, it's silver bars. And just like a bank run, the system only works as long as everyone doesn't show up asking for their metal at the same time. Friday might have been the beginning of that run. The Perth Mint suspending sales wasn't an isolated incident, it was a canary in the coal mine. If a government-backed mint can't source metal at $117, what happens when hundreds of thousands of retail buyers show up at 84 demanding delivery? Let me put this in perspective with a scenario you can relate to. Imagine you've got a gift card to your favorite store worth $117. You show up to use it, and they tell you they're out of inventory. Come back next week. You wait. You come back. Now your gift card says it's only worth $84 due to market conditions, but the store still doesn't have any inventory. In fact, they tell you that if you want the actual product, you'll need to pay $110 in cash, not the $84 gift card value. That's exactly what's happening in silver right now. Your Comex contract, your ETF share, your trading platform position, those are gift cards. The actual metal is the product. And the store is running out of product while telling you your gift card is worth less. According to metals dealer surveys conducted over the weekend, delivery times for physical silver have extended from the typical 2 to 3 days to anywhere from 2 to 6 weeks for large orders. Some dealers are simply refusing to lock in prices for future delivery because they don't know if they'll be able to source metal at current spot prices. Think about what that means. These are businesses that have operated successfully for decades, buying and selling metal. They understand the spread between bid and ask. They know how to manage inventory. And right now, they're so uncertain about the supply situation that they won't commit to delivering metal at guaranteed prices, even with customers willing to pay premiums. The World Gold Council, in their latest precious metals quarterly report, noted that silver ETF outflows in the fourth quarter of 2025 were the lowest in 3 years, while physical coin and bar demand reached the second highest level on record. Translation, people are pulling out of paper silver and moving into physical. They're voting with their dollars, choosing the real thing over the promise. Now, here's the calculation that should keep the Comex up at night. If even 5% of paper silver holders demand physical delivery, that's 30 million ounces against 46 million in registered inventory. If 10% demand delivery, the system breaks. The warehouse is empty. The defaults begin. And silver prices don't just go to 100 or 200. They go to whatever price it takes to find the metal. Have you noticed how quiet the mainstream financial media has been about silver since Friday? How they covered the crash extensively, but aren't asking any questions about why physical premiums haven't dropped, why the mints are closed, why dealers can't source inventory? That silence is deafening, because the moment they start investigating those questions, the whole story unravels. If this analysis is opening your eyes to what's really happening, do me a favor, smash that like button and share this video. The algorithms suppress content that questions the official narrative, so every like and share helps get this information to people who need to see it. Let's talk about what this means for your personal financial strategy going forward. I'm not a financial advisor, and this is not financial advice. I'm just a guy sharing data and asking questions. The establishment doesn't want asked. But here's what the evidence suggests. The gap between paper silver and physical silver is now a structural feature of the market, not a temporary anomaly. That gap represents what I call the insurance premium. The cost of owning the real asset versus a failing paper promise. At $84 spot and $110 physical, you're paying a $26 insurance premium to hold actual metal. Is that premium expensive? Maybe. But what's the cost of holding paper when the system breaks? According to Federal Reserve data, M2 money supply has increased by over 40% since 2020. That's 40% more dollars chasing roughly the same amount of goods and services. Silver supply, meanwhile, hasn't increased 40%. In fact, mine production has been relatively flat. So you've got 40% more currency units competing for the same physical metal. The math isn't complicated. The 200-day moving average for silver currently sits at $62. Even after Friday's crash, we're 36% above the long-term trend. That tells you this is not a bubble that popped. It's a structural repricing that got a violent correction but remains intact. Bubbles don't maintain 36% premiums to their long-term averages after a 35% crash. Strong trends do. So here's your roadmap for Monday and beyond. Watch the $75 level. If silver holds above JPMorgan's buy zone, the probability of a snapback rally toward $100 is extremely high. Watch the physical premiums. If they stay elevated or widen further, that confirms the decoupling is accelerating. Watch the dealer inventories and mint production. If deliveries keep getting delayed and premiums keep rising, you're witnessing the transition from a functioning market to a broken market. And most importantly, watch what the smart money does, not what they say. JPMorgan didn't short more silver on Friday. They covered. They bought. They accumulated at the exact bottom. You think that was random? Or do you think they know something about what's coming that they're not sharing on CNBC? We are entering the era of the unobtainable ounce, not because silver is being hoarded by evil manipulators, but because the fractional reserve system that's kept prices suppressed for decades is finally colliding with physical reality. There aren't enough ounces to satisfy all the paper claims. There never were. Friday's crash was a stress test. The system failed. The mints couldn't deliver. The dealers couldn't restock. The physical market decoupled from the paper market. And now we're heading into Monday with the whole world watching to see if that decoupling is permanent. This isn't financial advice. This is financial intelligence. The kind of intelligence that helps you understand what's really happening beneath the surface of market headlines. The kind that helps you ask better questions, make more informed decisions, protect what you've worked for. If you found value in this analysis, subscribe to this channel, hit the notification bell, and drop a comment below sharing your thoughts on what Monday will bring. The community we're building here is people who refuse to accept the official story without evidence. People who look at the data themselves. People who understand that in times of monetary chaos, real assets matter. The great decoupling has begun. The paper market says one price, the physical market says another, and the gap between them is your invitation to choose which reality you want to participate in. The bell rings Monday at 9:30 a.m. Eastern. By 9:31, we'll know if 75 holds. By the end of the day, we'll know if the snapback is starting. And by the end of this month, we'll know if February becomes the 10th consecutive monthly gain, or if Friday really was the top. My money's on the continuation. The data says the bull market is intact. The fundamentals say the shortage is real. The evidence says the smart money is accumulating, not selling. And the physical premiums say the market knows something the screen price hasn't admitted yet. Welcome to the new era. The era where holding the real thing isn't just smart, it's essential. Because when the paper promises fail, only the metal in your hand will matter. This is AG, your personal financial worker, signing off. See you Monday when the market opens and the real story begins. Don't forget to like, subscribe, and share this with anyone who needs to understand what's really happening in our financial system. The truth doesn't spread itself. We have to spread it together. Stay sharp, stay informed, and remember, the screen shows you a price, the market shows you reality. Choose wisely.